I'm over them, so that's a good thing.
Yep.
All right, it's 2:00. I think we have everybody in here that we were waiting on.
Is George here?
Yeah, George.
George is in here.
Okay, sorry.
Yes, I'm here. I couldn't get my thing to unmute. I'm sitting here clicking.
Oh, here we are. I'm accustomed to Teams and Zoom not very often, so I didn't have everybody up here. Sorry.
All right, well, I'll go ahead and get started. Hello, everyone. Thank you for coming to the Finance Committee meeting for February 2023. I'm Lauren Dansicle, the current Corporate Secretary. Mr. Brunson was not able to attend today, so in his absence, I call the February 2023 Kentucky Housing Corporation Finance Committee meeting to order. Sarah, can you confirm that we have a quorum and that the press has been notified?
We do have a quorum and the press has been notified.
Thank you, Sarah. Well, due to the chair's absence, we will need an elected chair pro tem to preside over the meeting. Holly Johnson has graciously agreed to be chair pro tem for the Finance Committee today. Do you have a motion to elect chair pro tem Holly Johnson?
Yeah, this is Matt Wingate, the Cabinet for Economic Development. I'd make a motion for Secretary Johnson to serve as pro tem.
Thank you. Do I have a second?
This is George C. I'll second that.
Okay, I have a motion and I have a second to elect Secretary Johnson as chair pro tem. Any discussion? Hearing none, all in favor say aye.
Aye.
Opposed, like sign. Motion carries. Thank you. And Secretary Johnson, chair pro tem, I turn the meeting over to you.
All right. Thank you very much, Lauren. All right. It looks like the next order of business, we have a new board member. So we will be swearing in our new board member. I believe that is Bruce Brown. Is that correct?
That is.
All right. Well, congratulations. We are happy to have you on board here. And I believe that Sarah is going to do the honors. Is that correct?
Yes, ma'am.
Okay, Sarah.
All right, Mr. Brown, if you will just please affirm that the following is true. I, Bruce B. Brown, do solemnly swear or affirm that I will support the Constitution of the United States and the Constitution of this Commonwealth, and be faithful and true to the Commonwealth of Kentucky so long as I continue a citizen thereof, and that I will faithfully execute to the best of my ability the office of Board Member of Kentucky Housing Corporation according to law. And I do further solemnly swear or affirm that since the adoption of the present Constitution, I, being a citizen of this state, have not fought a duel with deadly weapons within this state nor out of it, nor have I sent or accepted a challenge to fight a duel with deadly weapons, nor have I acted as second in carrying a challenge, nor aided or assisted any person thus offending, so help me God.
I do. And I will.
All right, thank you. All right, the next item of business is consideration and approval of minutes from our September 29th Finance Committee meeting, which are part of your packet.
Hey.
Do I have a motion?
Okay, I've got to get hold of Neil. I will call. Okay, bye-bye, Michelle. Thank you.
Sorry. Okay, do we have a motion on the minutes from that September 29th meeting?
Matt Wingate for the Cabinet for Economic Development. I'll make a motion.
Okay, I have a motion. Do we have a second?
I'll second, Holly.
Thank you, Gail. Do we have all in favor?
Aye.
Aye.
Okay, opposed? All right, motion passes. Thank you, everyone. Minutes have been approved. And the next item of business, we'll turn it over to Jim Statler to give us the presentation of select financial reports.
Thank you, Madam Chairman. There's 4 items listed under agenda item 3. There's A, B, C, and D. Presentation of Kentucky Housing Corporation financial update as of December 31, 22. then B, the report of trading results of secondary market, C, loan servicing updates, and 4, update on financials. And those have all been provided to you in your packet, and I'm willing to go or able to go through the highlights and answer any questions you may have. So if we start with the schedule in front of you now, which is the pro forma statement of net position, this is a common statement. Most of you have seen it before. It's a comparison of where we are at December 31st of 22 and where we were at June 30 of 22. And as this schedule has shown for several years, we are continuing to decrease our total program purpose assets, which is intentional, and you can see it drop from 427 million to 407 million. And with that it's accompanied by a parallel drop in revenue bonds, and that's the continuing decrease in the size of our bond portfolio. Again, that's done on purpose as we've shifted all of our production for the last 10 years to secondary market and off balance sheet. And so those are moves that are anticipated and not unusual for June to December move. The other line I'll bring to your attention is line I, which is other liabilities, and you'll see a drop from 36 million to 20 million. In that account are the custodial accounts for our secondary market off-balance sheet servicing portfolios, including payoff dollars and tax and escrow dollars. And as everybody's well aware, property taxes are paid in the second half of the calendar year, and so the monies that were sitting there in June are gone by December, as well as we had fairly robust payoffs and payoff principals in those accounts, and then they're remitted out once every month. So what was there in June, it went out in July, and where payoffs have dropped rather precipitously in the last 6 months. And so not nearly as much payoff dollars in that account as of December 31st. If you go right down to the bottom of the page, and I highlight this every time we show this, line N, which is the total loan serviced for others, that's an off-balance sheet annuity generating asset. And it's what we monitor very closely because it is the future income of the servicing operation of the corporation. And we have had a small decrease in that over the last couple of years, but I'm happy to report that there is a 5.7% increase in that balance from June to December, as again, payoffs have completely dried up and we've managed to continue to produce new loans. And then the value of the annuity is expressed in what the servicing fee or the earnings on that balance is. And I'm happy to report also that there's an increase from 31.5 basis points to 31.8 basis points from June to December. And so generally the servicing portfolio is bigger and is generating per dollar a little bit more in revenue. Going to the next page, which is the pro forma statement of revenues, expenses, and changes in net position. You can see on line A an increase in investment income on mortgage loans. There is an error in that. That should actually show a decrease. And I'll explain a little bit about that in a little bit, but we didn't determine that until after these statements were generated. And then I want to drop down to line H because line A is high, then line H is high also. And so the general administrative expenses will be dropping by the same amount that we dropped the investment income up top. So net, there's no impact on this statement, but on those two lines, there'll be an adjustment made to it. The real key to this statement is line D and line F. You can see on line D, which is gains on sale of loans, those those of you who have been here for the last several years have become accustomed to very robust gains on sale of loans. And obviously with the market turmoil in all the markets, but in particular the house financing market, those gains are no longer attainable. There's a lot of convexity in the pricing of higher price securities, which is where we deliver our loans. And those gains have dried up for most intents and purposes, although the last couple of months they have rebounded to some degree. But nevertheless, the 6 months ended 22 versus 21 is $9.4 million lower on secondary marketing gains. The other line of interest and remarkability here, if you will, is line F. And with those increases in rates, any MBS securities or investments that we have on our books have to be marked to market under the rules of the accountants. And so as those rates go up, the value of those assets go down. So we lost $7.2 million in value, if you will, on those assets. Now that is a paper loss. It's a realized loss only if we sell the securities. We have no intention of selling the securities. And so they will either pay us off at par or should rates come back down, start to increase in value, and we'll mark those up through this very statement in the future. Going down to, line blank, the line between H and I is a line called interest on pension liability. And since we paid off the pension, we don't have any pension interest expense in 22 that we had in 21. So that's a pickup year versus year. So if you go down to line O, you can see that there's a decrease of $15 million in our recorded change in net position from 19 million last year to 3.7 this year. If you take or add back, if you will, the paper loss on securities gains, then we've actually lost $8.6 million year over year. We've made $8.6 million less than last year, year over year, from 19.6 down to just short of $11 million. So it's not a disaster, obviously. We're producing loans, and I've got a little bit more to go to say on that in a minute. And we are suffering what you'd expect us to suffer, some adverse impact of interest rates on the execution of the sales, and then decreases in market value attributable to write-downs of our investment portfolio. Excuse me. 2 lines of note on this schedule here, which is a cash flow statement. You can see on line B a huge decrease in cash flows from non-capital financing activities last year versus this year. We made a huge payment on the pension plan exit strategy in the 6 months ended December of 21. So that big drop is not unexpected and in fact expected. And then, as I mentioned, the repayments on mortgage loans, this is line I of this schedule. You can see that for the 6 months ended December of 21, we had $39 million of loans pay off. So far, the 6 months of fiscal 23 or through December of 22, only 23 million. And so loans are not paying off like they were. People are not refining their loans. People are not moving up. The housing market has, as you've read in the trade pubs or general newspapers, the housing market is completely mucked up. Refis are out of the market, and I think overall activity is down 80 to 85%, and that's reflected here in this number on this schedule. Going to the operating fee income budget versus actual number, most of my conversation on this is the 4th column over, dollar variance. And that is the variance of year-to-date actual performance versus year-to-date budget. And I pretty much concentrate on the big differences, the first of which is on line E, where we have our admin income from programs, primarily temporary COVID programs, is $2.4 million under budget. HHERF is sunset and is not going to generate as much income this year as we had projected. And the HOAF fund, Homeowners Assistance Fund, which is on the homeowner side, ERF is on the rental side. That is ramping up, but still not hitting full stride. And so we're a little bit behind on income there. There's a corresponding favorable variance, if you will, on the expense side, where we're not incurring the expenses that we need to have recovery via the admin fee on this top side of this schedule. Going to the middle of the page on line G, you can see servicing income is up over budget $519,000. That's a phenomenon of the forbearance programs on the mortgage portfolios nationwide being closed out with claims payments paid by HUD, VA, RHS, or Fannie Mae. And what was in those payments was, or amounts were in some cases 30 months of payments that were made all at one time, and included in those 30 months of payments was interest, which was not booked as income because it hadn't been received yet, and in servicing fees as well. That had not been recorded. And so as we were getting those big lump sums from HUD, mostly from FHA, because that's where most of our portfolio is, that number is exceeding budget by $500,000. If you look at rental production, that's a nice increase on line H. A lot of that is timing. our rental program projects are coming and going and funding, and that number is more a function of the calendar than really anything else. The budget, we budget those fees ratably over the year, and if one big project closes in December, then we're going to be favorable and year to date. And so that year to date favorable to the budget is likely to disappear between now and the end of the year, unless we grab a bunch of new projects that we had not anticipated when we set up the budget. Home ownership is 347 under budget. One of the biggest income items in there is what we call extension fees. Extension fees are collected from our lenders who do not deliver loans to us on time. Last year, all of our lenders were very busy with refis and a bunch of other stuff, and they were late delivering loans to us. And so we booked income from that last year, and then we budgeted assuming we were going to continue to get that this year. However, our lenders are not very busy now because about the only game in town is Kentucky Housing down payment assistance loans. And so they're able to deliver their loans on time, and therefore we're not realizing that income. And that will be an opportunity loss for this year, and probably not going to be made up between now and the end of the year. Okay, so on line L, we're $1.5 million under budget on income. On line O, we're $1.9 million under budget on expenses. So line P, we're actually performing on a net basis, $400,000 favorable to budget. Okay, so the $1,953,000 favorable to budget on expenditures is detailed on this schedule. You can see on line D, total personnel costs are $1.4 million under budget, favorable. Again, we were not spending on staffing and contractors and outside services to accomplish the HHERF COVID program, and so we did not incur as much expense there, and conversely did not collect as much admin on the other side. Just going down through a couple of the line items, G, you can see that there's an unfavorable amount of $246 regarding foreclosure costs and release fees. That is one of the G&A expenses that did not get income credited to it that I discussed on the income statement a few moments ago. And so when that gets corrected, that negative will be either significantly reduced or potentially turn positive. I'm going to skip down to line O, liquidation shortfall. That is another account that was shorted income to the benefit of the interest income discussed prior. That number will also not turn positive, but the negativity of that will be decreased as that line will be reduced by a reclass that we're going to make here in the first quarter. A couple other numbers on here, the 311 on equipment and software, and office supplies, 103,000. Most of that is computer hardware. We expense in office supplies relatively cheap laptops. We anticipated having to buy a number of laptops in support of the COVID programs. We're not going to buy them. That number should be favorable for the rest of the year. And equipment and software is similar, although there is some timing in that some of that under budget will catch up to us in the second half of the year as certain projects come to fruition. I guess the most other glaring item here is the negative down at the bottom, line Z, Kentucky Affordable Housing Conference. We incurred and have in financial statements all the expenses associated with that conference, but there was a $90,000 income remittance for participant fees that was not booked until January. Excuse me. So that will turn a little bit positive, which is which was the numbers that we've gotten from Molly in the marketing department for performance or the net results of putting on the Affordable Housing Conference. Any questions on the normal financial statements, if you will, before I get into some of the more diagnostic stuff on the agenda? Okay, this schedule here and the agenda calls for conversation of creating gains on secondary, which is item number 3B. That's what we have at the top of this. The yellow is this year to date. The blue is last year to date. And the pink is 2020 year to date. And as you can see in the Ginnie Mae gain dollars, a sizable decrease, a remarkable decrease, if you will, from 20,000,007 gained in 2020 to 11 million gained last year to $1.5 million gain this year. And that is the market. And if I had my video on, you'd see how much whiter my hair is today than it was 6 months ago. It's a very difficult market to trade through. Tracy Thurston is quite a capable trader, being come under fire on the markets and what the market can do to you. We are sacrificing gain to preserve volume. And my experience in mortgage banking over the last 4 decades is if you shut down a production unit, it's extremely difficult to start it back up. And so we are not going after the giant gains. Really, the giant gains are not in the market right now, but we are not going berserk trying to get the biggest gains possible, but we're going for the volume. And that's showing up as an increase in the portfolio on the chart that I showed a moment ago, and a little bit better execution on the servicing fee. So while it's not great from a bottom line standpoint, the year so far is still not a disaster, and we still have some gains coming through, and we have growth this year where we did not have the growth necessarily in years past. Speaking of growth, the next section there in servicing portfolio highlights total dollars. You can see that from December of 20 in the orange to December of 21 in the blue, we lost portfolio size. And then in the year since, in the yellow this year, we've gained most of it back. And so we are setting the table for the future by building the portfolio, sacrificing some gains this year potentially, and performance on the gain side, but building the portfolio so that we can have the annuity stream that the servicing portfolio has thrown our way in the last several years. If you look at the weighted average servicing fee, that statistic was also shown on a previous schedule, but in serviced for others, the 31.8% or 31.8 basis points compared to the 31.6. Those are numbers you want to see keep going up because that's the earnings rate of that annuity. Excuse me. And so that is a positive sign also. And so there's a number of good things happening, and I don't want to have the emphasis has been on the gains for so many years, which has been extremely fortunate to have experienced. There's a lot of good things happening despite the fact that the gains are not as robust as they've been in the past. Another bright spot is not only is the portfolio bigger, but its performance parameters are better, and that's in the delinquency ratio down below. And you can see I'm going to zero in on the 90-plus day, 178 this year, 404 last year, 391 the year before. Those high rates in last year and the year before is because of all the loans that were in forbearance. Everybody that was in forbearance went the max. And so we have loans, last year at this time, we had loans that were 24 payments behind. And all of those payments were sitting in the 90-day, obviously if they're 24 behind, they're in the 90-day bucket. Conversely, we could not foreclose on anybody because of the foreclosure moratorium. And therefore, we have more loans in foreclosure now, since the moratorium's been lifted, than we had in the last 2 years. And it is returning to a normal, if you will, foreclosure ratio, and not of any great concern as a trend or something that's going to go to 2 or 3%, because that's not we don't see that happening. So putting loans in is difficult. Getting the loans is difficult, but the loans that we've got are generating income. They're performing the way, or becoming more performing the way we were accustomed to in the past. The 90-plus day that I just mentioned at 178, that should be under 1% as the last of the COVID moratorium loans or forbearance loans get resolved either through loss mit or brought current otherwise. Molly, keep that right there at the bottom. No, there you go, the text. And try as I might, I worked with the photocopier and tried to enlarge this so that everybody could see it and get it straight on the photocopier. And try as I might, it came up crooked. And so I apologize for the slight tilt to the left or to the right. But the financing plan is at these meetings that the finance committee meets, we bring to the committee what the financing plan is. And for the last 8 years, the financing plan, we're going to continue with the secondary mortgage market purchase program because that was the highest and best execution available. It's becoming apparent that the issuance of tax-exempt bonds may be able to increase our production a little bit, increase our penetration to the population of Kentucky that needs first-time home buyer financing that we cannot provide through the secondary mortgage market purchase program. And so we will be presenting to the board next week an agenda item requesting authorization to explore the feasibility and development and execution of a financing plan to issue up to $100 million of tax-exempt housing revenue bonds that will not necessarily cannibalize the production coming in the secondary market mortgage purchase program activity, but will supplement it and give us a little bit more product and help us fulfill our mission just a little bit better than we would have if we were staying strictly with the secondary program. We were able to run both programs simultaneously. They have different metrics as to eligibility and underwriting guidelines. Production will be government loans primarily, and which are primarily FHA, and the company, that's all it did up till about 2008, 2009, and we're dipping our toe back into that water. We have a bond cap from 2021 in excess of $100 million that we can use, and then we expect to receive $150 to $200 million of bond cap here in calendar 23 as well. So there's that bond cap is also used by the multifamily program, so it is a rare commodity, but the $100 million from 21 is dedicated to single family, and we're going to try to use it up in a tax exempt bond issue. Excuse me just a minute. So this schedule, and I don't think I've ever shared this with the committee. We started the secondary product market back in 2012, and we keep track of its performance. And as dismal as the performance is in 2023, you can see in the cash gains column of this schedule how robust it has been in the last 3 or 4 years. And so it's not like we've been limping along with it. We built a fund balance up of over $100 million and used a lion's share of it to help us exit the pension program, which you can see coming out in 2022. Going forward, we anticipate the program to continue to generate gains. And at right now, the long-term lookout on those gains is to contribute much of it over to the Housing Assistance Fund for putting it back into mission purposes, which is what the HAF is set up to do, rather than accumulate it in the secondary mortgage market fund balance, where it's really not needed necessarily because we don't need $35 million in that account. It's there. It doesn't do us any good if we don't use it, and so we're looking to dedicate much of that over to the HAF going forward. But it does give you some idea of how much we've benefited from the program, and seeing how big those gains were in 20 and 21, and so it's a remarkable drop back this year. But those of us who've been in the business for 45 years have seen this before, and it's not unusual, but it's something you have to live through so you can get back to those greener days 5 years out. So anyway, that's to give you some perspective. I think most of the committee has heard it in piecemeal during the presentations, but this kind of ties it all together into one picture of where we are or where we've come from. Okay, Molly, thank you. Okay, when I said the portfolio grew, you can see on this chart, and this chart goes back to 2008. The black bars are outstanding bonds. The red bars are our servicing portfolio, whether on the books or not. And you can see that as we have dropped our bond portfolio, the on-book portfolio dropped right with those black lines. And so the red lines over and above the black lines are the servicing portfolio that is not on the books, but is an income producer for the corporation. And so we keep track of how big it is in a notional amount. And we also keep track of what the basis point earnings basis on it are. And you can see that after dipping a little bit over the last couple of years, and as the charts reflected, we are in a growth mode again on the notional balance. of the servicing portfolio, which is the direction we want to go. And the intentional drop in bonds has been that the bonds were not as profitable a funding source for the last 10 years, but we're exploring them becoming a funding source going forward as being having a little bit more efficacy in today's market. But anyway, that's a nice graphic illustration of where we've been, where we're going, and how we've lost a little bit, but picking it back up. Excuse me. This chart is, I'll explain it a little bit, but where the blue line starts climbing on the right of the chart is when COVID hit. And the blue line is not a delinquent loan ratio, it's a delinquent payments ratio. And so if you look at the red line, that is how many loans were delinquent. And the blue line is an indication of how delinquent those loans were. And all through COVID, until we started getting relief with the forbearance expiring about a year ago, everybody got further and further and further behind. And so the red line stayed reasonably flat, but each one of those red line borrowers got one more payment behind. And you can see how high the delinquent payments ratio got. In that line is interest that is not collected. It is escrow funds that are not collected to pay taxpayer or homeowners property taxes and insurance, and servicing fee that is owed to us, and principal pieces that are owed to Ginnie Mae security holders. And so the corporation has had to front those missing payments to keep everything paid as they should be. When COVID was announced in 2020, we anticipated that this would happen, and we got additional lines of credit to afford us of the ability to not get into a short squeeze on liquidity. And so we've been able to weather it fairly nicely. Now you can see after it reached its zenith about a year to 14 months ago, we're starting to collect all those forbearance payments, and we're getting them all at one time. And so this loan that was 24 payments behind, we get 24 payments from HUD, bring the loan current, modify it, whatever we have to do to get the loan back on a solid footing. And all those payments that are being reflected as being collected. And you can see that the blue line, hopefully in the next 3 or 4 months, will be back down to where it was at a low point there in the middle of the chart. But again, this is a nice graphic illustration of some of the turmoil that the company was coming through, just on the loan servicing portfolio, notwithstanding the rallying over in on the rental operations and the other programs that we've been administering for the last 3 years. And so it'll be kind of nice to get back to a little bit of normalcy, I think, if we're able to. But I think this is, again, a nice graphic to show where it was, how bad it got, and how well it's improving. If you look at this chart, we have to keep track of how many loans are in COVID forbearance, how many exit, how many come back, which portfolio they're in, how delinquent they are, et cetera, et cetera. We've been doing that since the beginning of COVID. We have to report that to national, we report it to the MBA primarily, but Fannie Mae rating agencies get this information. You can see at the end of January, there are only 183 loans still in COVID forbearance protection. In August of 2020, hang on. In August 2020, that number was 1,639 loans. And so you can see that, and if you recall the blue line on the chart before, in those 639 loans were maybe 10 to 12 payments in August of 2020 and 24 to 30 payments in them as we got closer and toward the end of 2021. So you can see that it's come and gone, and we're getting rid of these loans at about 40 to 50 loans a clip. And so hopefully when the forbearance program actually sunsets in May, then we will have no more loans going into COVID protection, and we'll be able to mop up these and not have to keep track of them any much longer. So it's been a long 3 years. Been profitable. It's kind of been fun. It's been exciting, but a lot of people suffered, and hopefully we're going to get, if we can get these interest rates and everything back under control with the inflation. With the inflation, then we'll have clean sailing for a few years. That's my presentation, everybody. Any questions? Excuse me.
Okay. All right. Thank you, Jim. That was a very nice presentation. A lot of good information there.
Thank you.
All right. Next item is informational items from me, and I don't have any, so we will move past that pretty quickly. The next item is items from the board or staff. So does the board or staff have any items for this group?
This is me again, Holly. I'd like to thank everybody for taking time out of their schedule to make this meeting. This meeting happens once or 3 times a year, and I know everybody's busy like we are, and so I appreciate everybody taking time and joining us today.
Okay. Thank you, Jim. All right. No one else? Okay. I'm going to keep moving, guys. All right. All right. Well, then the next item is adjournment. Do we have a motion for adjournment?
So moved, Holly. Gail.
Thank you, Gail. Wait a second.
Matt seconds.
All right, Matt. Thank you. All in favor?
Aye.
Aye. All right. Thank you all very much. Appreciate your time this afternoon.
Thank you.